guys. In this recording, I'm going to be working through the mock test, Smartshop Holdings Limited. Please make sure that you have attempted the question under exam conditions before watching this recording.
So what we're going to do is first we have 15 minutes to read through the information provided in the question. And during this time, we are going to identify positive and negative points. All positive points will be marked off with a tick, and all negative points with a cross. All right, so let's start by reading through the information provided. Smartshop Holdings Limited, or Smartshop, is an investment holding company listed on the Johannesburg Securities Exchange, or the JSE. So the fact that the company is listed is obviously a positive point because it's easier for them to raise new finance if necessary. The group operates in the supermarket and produce distribution industries, and their primary focus is the sale of groceries and other household products. All right, so they are in the supermarket and produce distribution industries, and they focus on the sale of groceries and other household products. Smartshop is one of the largest retailers in South Africa with 1,582 stores and 17 distribution centers. All right, so if they're one of the largest retailers in South Africa with so many stores and distribution centers, that means that the company is well established, which is obviously positive. And in addition to that, guys, they should be able to use their size to their advantage and qualify for bulk discounts from their suppliers because they are purchasing products for so many stores. Smartshop is a price leader and they aspire to be the most affordable retailer across South Africa. The VAT increase, petrol price increases, the recent drought in the Western Cape, poor gross domestic product growth, and the high level of unemployment continue to weigh heavily on customers. All right, guys, so we are dealing with a very tough economic environment as a result of all of these things that are listed over here. So all of that is obviously making things very difficult for customers, and if customers have less money available to spend, that could have a negative impact on sales or on the demand for Smartshop's products. So that's obviously negative. They are dealing with an extremely tough environment. The group performed well in this extremely tough environment, increasing sales by 5.2% and profit by 1.5%. They experienced positive customer growth in terms of number of customers and number of customer trips to stores. All right, so despite the fact that we are dealing with a very tough environment, the group still performed very well and they have also shown growth. So that is obviously positive. The listeriosis outbreak in 2018 raised food safety concerns for customers. Smartshop acted swiftly to protect customers' health and safety in the listeriosis outbreak through recalls and a range of additional safety checks. So obviously, guys, the listeriosis outbreak in 2018 is negative because it creates food safety concerns for customers, so that's obviously negative. However, they did react to everything very quickly. So they acted swiftly to protect customers' health and safety through recalls and a range of additional safety checks. So that's obviously very positive. The outbreak might not be under their control, but how they handle it is obviously very important. Government's efforts to keep citizens safe and healthy led to increased regulation. And as a result of this, Smartshop operates in a dynamic and continuously evolving regulatory environment. All right, guys, and that is going to be negative because if regulations are continuously changing and increasing, there's obviously a risk of non-compliance. So there's obviously a lot of new laws and regulations that they would need to comply with. Smartshop is one of the largest private sector employers in South Africa. So that is obviously positive from a social perspective because they are creating jobs. Late trading is a common feature of the retail industry, and Smartshop relies heavily on the flexibility of their employees to meet the fluctuation in seasonal and customer shopping patterns. This led to strike action during the 2018 financial year. All right, so obviously during different seasons and depending on customer shopping patterns, stores stay open a little bit later. So we see that especially around the Christmas period, late trading where retail shops stay open a little bit later. And that obviously has a negative impact on the employees who have to work a lot later, and that led to strike action. For Smartshop, that is going to be negative because the strike action would obviously have a negative impact on the operations. South Africa is a water-scarce country, and the price of water is expected to rise in coming years in attempts to curb consumption. Smartshop depends on a reliable supply of water to maintain hygiene and sanitation standards in its stores and distribution centres, provide drinking water for its extensive staff component, and for production in its bakeries and fresh food departments. Water is also essential for automatic fire sprinkler systems and some air conditioning and refrigeration systems. All right, so Smartshop is highly dependent on water. So this is obviously negative because any shortages could obviously affect business continuity, and if there is any increase in the price of water, this would have a negative impact on profitability. Smartshop uses social media as a marketing channel and customer response, retention, and recovery mechanism, as well as a brand building medium. So that's obviously positive because social media is just another way that they can reach their customers. Customers increasingly communicate with Smartshop via social media platforms. Now guys, that can be very negative because if customers raise complaints on social media platforms, that can create negative publicity, brand damage, reputational risk, etc. We then have information relating to a reverse distribution model. In terms of current agreements, suppliers of non-perishable products deliver to Smartshop distribution centres across the country. Smartshop then uses their own fleet of delivery trucks to transport these products to their stores. Suppliers of perishable products deliver directly to Smartshop stores across the country. All right, guys, so obviously when it comes to non-perishable products, they're not in so much of a rush to get the product to their stores. So the suppliers first deliver to distribution centres, and then Smartshop delivers from the distribution centre to their stores. When it comes to perishable products, they need to get the product to their stores a lot quicker. So then the suppliers deliver directly to their stores. So guys, obviously Smartshop sells grocery items. We know that part of the grocery items or some of their inventory is perishable products. So that is obviously subject to wastage, and that is negative. All right, guys, so this is in terms of current agreements. That's what they are currently doing. We are then told during the 2019 financial year, Smartshop plans to invest in a new fleet of temperature-controlled trucks. Through a reverse distribution model, Smartshop will collect perishable products directly from suppliers. All right, so in terms of current agreements, suppliers of perishable products deliver directly to Smartshop stores across the country. That is now going to change with this reverse distribution model, where Smartshop is going to collect the perishable products directly from their suppliers. Smartshop will be one of the first retailers to use cryogenic refrigeration to transport perishable products. This technology, which replaces diesel-fueled transport refrigeration, is powered by liquid nitrogen and has zero carbon dioxide emissions. So obviously that's very positive from an environmental perspective. Smartshop has maintained a constant dividend cover of 4 times over the past 5 years. Dividends during this period were as follows. All right, so you've been given the dividend per share in cents for 2014, 15, 16, 17, and 18. So the dividend per share for the past 5 years. And during this period, the company maintained a constant dividend cover of 4 times, meaning that earnings covered dividends 4 times. earnings for the 2019 financial year are expected to be 3,000 cents per share, and the directors plan to increase the dividend cover to 5 times in the 2019 financial year to fund the new reverse distribution model. All right, so this reverse distribution model that was described above is obviously going to cost the company money. So to fund this, they are going to increase their dividend cover to 5 times in the 2019 financial year. So guys, the problem is, for the past 5 years, the company's maintained a constant dividend cover of 4 times, meaning that their earnings cover their dividends 4 times. This is now going to increase to 5 times, meaning that earnings are going to cover dividends 5 times. Now remember, the dividend cover is just the inverse of the payout ratio. So if we want to calculate the payout ratio, we just say 1 divided by 4, which is going to give us 25%. So that means over the past 5 years, the company paid out 25% of their earnings as a dividend. Now they are going to change their cover to 5 times. So calculate the payout ratio. The payout ratio is now going to drop. Instead of paying out 25% of their earnings as a dividend, they are now only going to be paying out 20% of their earnings as a dividend. And the rest of the money is going to be kept in the company to fund this new reverse distribution model. So obviously, guys, if they are now changing their dividend policy and they are paying out a smaller percentage of their earnings as a dividend, that could have a negative impact on their share price because of the signaling effect. We then have information relating to new appointments. Smartshop is currently looking for a new management accountant to join their team. The financial manager provided each of the candidates with a simple test to evaluate their skills. Based on the information below, each candidate was required to calculate the weighted average cost of capital as at the 31st of December 2018. All right, so this is the information that was provided to each candidate. They've been given information relating to equity. The yield on an R186 RSA bond with an expiry date in 5 years is 6%. The yield on an R153 RSA bond with an expiry date in 10 years is 9%. The market rate is 14% and beta is 1.2. Then there's also a long-term loan. Smartshop entered into a loan agreement with their bankers on the 1st of January 2016 for an original amount of 10 million rand. The interest rate on the loan is 11%. The loan capital and interest are repayable in a single bullet payment on the 31st of December 2020. Smartshop currently has a debt to equity ratio of 0.55:1 and a target debt to equity ratio of 0.8:1. So you've been given both the current debt to equity ratio and also the target debt to equity ratio. Then on the next page, the following calculation was submitted by one of the candidates. All right, so this is where one of the candidates are calculating the weighted average cost of capital as at the 31st of December 2018. All right, and we'll look at this in a bit more detail when we actually know what the required is expecting from us. All right, guys, that is then all of the information provided in the question.